A banknote, also called a bill, North American English, paper money, or simply a note, is a type of negotiable promissory note, made by a bank or other licensed authority, payable to the bearer on demand. Banknotes were originally issued by commercial banks, which were legally required to redeem the notes for legal tender, usually gold or silver coin, when presented to the chief cashier of the originating bank. These commercial banknotes only traded at face value in the market served by the issuing bank. Commercial banknotes have primarily been replaced by national banknotes issued by central banks or monetary authorities. National banknotes are often, but not always, legal tender, meaning that courts of law are required to recognize them as satisfactory payment of money debts. Historically, banks sought to ensure that they could always pay customers in coins when they presented banknotes for payment. This practice of backing notes with something of substance is the basis for the history of central banks backing their currencies in gold or silver. Today, most national currencies have no backing in precious metals or commodities and have value only by fiat. With the exception of non-circulating high-value or precious metal issues, coins are used for lower-valued monetary units, while banknotes are used for higher values. Code of Hammurabi Law 100, c. 1755 to 1750 BC, stipulated repayment of a loan by a debtor to a creditor on a schedule with a maturity date specified in written contractual terms. Law 122 stipulated that a depositor of gold, silver, or other chattel/movable property for safekeeping must present all articles and a signed contract of bailment to a notary before depositing the articles with a banker, and Law 123 stipulated that a banker was discharged of any liability from a contract of bailment if the notary denied the existence of the contract. Law 124 stipulated that a depositor with a notarized contract of bailment was entitled to redeem the entire value of their deposit, and Law 125 stipulated that a banker was liable for replacement of deposits stolen while in their possession. In China during the Han Dynasty, promissory notes appeared in 118 BC and were made of leather. Rome may have used a durable lightweight substance as promissory notes in 57 AD, which have been found in London. However, Carthage was purported to have issued banknotes on parchment or leather before 146 BC. Hence Carthage may be the oldest user of lightweight promissory notes. The first known banknote was first developed in China during the Tang and Song dynasties, starting in the 7th century. Its roots were in merchant receipts of deposit during the Tang dynasty, 618 to 907, as merchants and wholesalers desired to avoid the heavy bulk of copper coinage in large commercial transactions. During the Yuan dynasty, 1271 to 1368, banknotes were adopted by the Mongol Empire. In Europe, the concept of banknotes was first introduced during the 13th century by travelers such as Marco Polo, with European banknotes appearing in 1661 in Sweden. Counterfeiting, including the forgery of banknotes, is an inherent challenge in issuing currency. It is countered by anti-counterfeiting measures in the printing of banknotes. Fighting the counterfeiting of banknotes and checks has been a principal driver of security printing methods development in recent centuries. Paper currency first developed in Tang Dynasty China during the 7th century, where it was called flying money, although true paper money did not appear until the 11th century, during the Song dynasty. The use of paper currency later spread throughout the Mongol Empire or Yuan dynasty China. European explorers like Marco Polo introduced the concept in Europe during the 13th century. Napoleon issued paper banknotes in the early 1800s. Cash paper money originated as receipts for value held on account, value received, and should not be conflated with promissory sight bills which were issued with a promise to convert at a later date. The perception of banknotes as money has evolved over time. Originally, money was based on precious metals. Banknotes were seen by some as an IOU or promissory note, a promise to pay someone in precious metal on presentation, see representative money. But they were readily accepted, for convenience and security, in London, for example, from the late 1600s onwards. With the removal of precious metals from the monetary system, banknotes evolved into pure fiat money. The first banknote type instrument was used in China in the 7th century, during the Tang dynasty, 618 to 907. Merchants would issue what are today called promissory notes in the form of receipts of deposit to wholesalers to avoid using the heavy bulk of copper coinage in large commercial transactions. Before the use of these notes, the Chinese used coins that were circular, with a rectangular hole in the middle. Coins could be strung together on a rope. Merchants, if they were rich enough, found that the strings were too heavy to carry around easily, especially for large transactions. To solve this problem, coins could be left with a trusted person, with the merchant being given a slip of paper, the receipt, recording how much money they had deposited with that person. When they returned with the paper to that person, their coins would be returned. True paper money, called jiaozi, developed from these promissory notes by the 11th century, during the Song dynasty. By 960, the Song government was short of copper for striking coins, and issued the first generally circulating notes. These notes were a promise by the ruler to redeem them later for some other object of value, usually specie. The issue of credit notes was often for a limited duration, and at some discount to the promised amount later. The jiaozi did not replace coins but was used alongside them. The central government soon observed the economic advantages of printing paper money, issuing a monopoly for the issue of these certificates of deposit to several deposit shops. By the early 12th century, the amount of banknotes issued in a single year amounted to an annual rate of 26 million strings of cash coins. By the 1120s, the central government started to produce its own state-issued paper money, using woodblock printing. Even before this point, the Song government was amassing large amounts of paper tribute. It was recorded that each year before 1101, the prefecture of Xianan, modern Shangxian, Anhui, alone would send 1,500,000 sheets of paper in 7 different varieties to the capital at Kaifeng. In 1101, the Emperor Huizong of Song decided to lessen the amount of paper taken in the tribute quota, because it was causing detrimental effects and creating heavy burdens on the people of the region. However, the government still needed masses of paper product for the exchange certificates and the state's new issuing of paper money. For the printing of paper money alone, the Song government established several government-run factories in the cities of Huizhou, Chengdu, Hangzhou, and Ankai. The workforce employed in these paper money factories was quite large. It was recorded in 1175 that the factory at Hangzhou alone employed more than 1,000 workers a day. However, the government issues of paper money were not yet nationwide standards of currency at that point. Issues of banknotes were limited to regional areas of the empire, and were valid for use only in a designated and temporary limit of 3 years. The geographic limitation changed between 1265 and 1274, when the late Southern Song government issued a nationwide paper currency standard, which was backed by gold or silver. The range of varying values for these banknotes was perhaps from 1 string of cash to 100 at the most. 15 ever after 1107, the government printed money in no less than 6 ink colors and printed notes with intricate designs and sometimes even with mixture of a unique fiber in the paper to combat counterfeiting. The founder of the Yuan dynasty, Kublai Khan, issued paper money known as jiaoqiao. The original notes were restricted by area and duration, as in the Song dynasty, but in the later years, facing massive shortages of specie to fund their rule, the paper money began to be issued without restrictions on duration. Venetian merchants were impressed by the fact that the Chinese paper money was guaranteed by the state. The modern banknote rests on the assumption that money is determined by a social and legal consensus. A gold coin's value is simply a reflection of the supply and demand mechanism of a society exchanging goods in a free market, as opposed to stemming from any intrinsic property of the metal. By the late 17th century, this new conceptual outlook helped to stimulate the issue of banknotes. The economist Nicholas Barbon wrote that money was an imaginary value made by a law for the convenience of exchange. A temporary experiment of banknote issue was carried out by Sir William Phipps as the governor of the province of Massachusetts Bay starting on December 20, 1690 to help fund the war effort against France. The other 13 colonies followed in Massachusetts' wake and began issuing bills of credit, an early form of paper currency distinct from banknotes, to fund military expenditures and for use as a common medium of exchange. By the 1760s, these bills of credit were used in the majority of transactions in the 13 colonies. The first bank to initiate the permanent issue of banknotes was the Bank of England. Established in 1694 to raise money for the funding of the war against France, the bank began issuing notes in 1695 with the promise to pay the bearer the value of the note on demand. They were initially handwritten to a precise amount and issued on deposit or as a loan. There was a gradual move toward the issuance of fixed denomination notes, and by 1745, standardized printed notes ranging from £20 to £1,000 were being printed. Fully printed notes that did not require the name of the payee and the cashier's signature first appeared in 1855. The Scottish economist John Law helped establish banknotes as a formal currency in France, after the wars waged by Louis XIV left the country with a shortage of precious metals for coinage. Originally, the banknote was simply a promise to the bearer that they could redeem it for its value in specie, but in 1833 the second in a series of bank charter acts established that banknotes would be considered as legal tender during peacetime. Until the mid-19th century, commercial banks were able to issue their own banknotes, and notes issued by provincial banking companies were the common form of currency throughout England, outside London. The Bank Charter Act of 1844, which established the modern central bank, restricted authorization to issue new banknotes to the Bank of England, which would henceforth have sole control of the money supply in 1921. At the same time, the Bank of England was restricted to issue new banknotes only if they were 100% backed by gold or up to £14 million in government debt. The Act gave the Bank of England an effective monopoly over the note issue from 1928. Today, a central bank or treasury is generally solely responsible within a state or currency union for the issue of banknotes. However, this is not always the case, and historically the paper currency of countries was often handled entirely by private banks. Thus, many different banks or institutions may have issued banknotes in a given country. Commercial banks in the United States had legally issued banknotes before there was a national currency, however, these became subject to government authorization from 1863 to 1932. In the last of these series, the issuing bank would stamp its name and promise to pay, along with the signatures of its president and cashier on a pre-printed note. By this time, the notes were standardized in appearance and not too different from Federal Reserve notes. In a small number of countries, private banknote issue continues to this day. For example, by virtue of the complex constitutional setup in the United Kingdom, certain commercial banks in two of the state's four constituent countries, Scotland and Northern Ireland, continue to print their own banknotes for domestic circulation, even though they are not fiat money or declared in law as legal tender anywhere. The UK's central bank, the Bank of England, prints notes which are legal tender in England and Wales. These notes are also usable as money, but not legal tender, in the rest of the UK. See banknotes of the pound sterling. In the two special administrative regions of the People's Republic of China, arrangements are similar to those in the UK. In Hong Kong, 3 commercial banks are licensed to issue Hong Kong dollar notes, and in Macau, banknotes of the Macanese Pitaka are issued by 2 different commercial banks. In Luxembourg, the Banque Internationale à Luxembourg was entitled to issue its own Luxembourgish franc notes until the introduction of the euro in 1999. As well as commercial issuers, other organizations may have note-issuing powers. For example, until 2002 the Singapore dollar was issued by the Board of Commissioners of Currency, Singapore, a government agency which was later taken over by the Monetary Authority of Singapore. As with any printing, there is also a chance for banknotes to have printing errors. For U.S. banknotes, these errors can include board break errors, butterfly fold errors, cutting errors, dual denomination errors, fold over errors, and misalignment errors. In the United States there were early attempts at establishing a central bank in 1791 and 1816, but it was only in 1862 that the federal government of the United States began to print banknotes. Prior to the introduction of banknotes, precious or semi-precious metals minted into coins to certify their substance were widely used as a medium of exchange. The value that people attributed to coins was originally based upon the value of the metal unless they were token issues or had been debased. Banknotes were originally a claim for the coins held by the bank, but due to the ease with which they could be transferred and the confidence that people had in the capacity of the bank to settle the notes in coin if presented, they became a popular means of exchange in their own right. They now make up a very small proportion of the money that people think that they have, as demand deposit bank accounts and electronic payments have negated much of the need to carry notes and coins. Banknotes have a natural advantage over coins in that they are lighter to carry, but they are also less durable than coins. Banknotes issued by commercial banks had counterparty risk, meaning that the bank may not be able to make payment when the note was presented. Notes issued by central banks had a theoretical risk when they were backed by gold and silver. Both banknotes and coins are subject to inflation. The durability of coins means that even if metal coins melt in a fire or are submerged under the sea for hundreds of years, they still have some value when they are recovered. Gold coins salvaged from shipwrecks retain almost all of their original appearance, but silver coins slowly corrode. Other costs of using bearer money include 1. Discounting to face value. Before national currencies and efficient clearing houses, banknotes were only redeemable at face value at the issuing bank. Even a branch bank could discount notes of other branches of the same bank. The discounts usually increased with distance from the issuing bank. The discount also depended on the perceived safety of the bank. When banks failed, the notes were usually partly redeemed out of reserves, but they sometimes became worthless. The problem of discounting within a country does not exist with national currencies. 2. Counterfeiting paper notes has always been a problem, especially since the introduction of color photocopiers and computer image scanners. Numerous banks and nations have incorporated many types of countermeasures in order to keep the money secure. However, extremely sophisticated counterfeit notes known as superdollars have been detected in recent years. 3. Manufacturing or issue costs. Coins are produced by industrial manufacturing methods that process the precious, semi-precious, or other metals, and require additions of alloy for hardness and wear resistance. By contrast, banknotes are printed paper, or polymer, and typically have a higher cost of issue, especially in larger denominations, compared with coins of the same value. 4. Wear costs. Banknotes do not lose economic value by wear, since, even if they are in poor condition, they are still a legally valid claim on the issuing bank. However, banks of issue do have to pay the cost of replacing banknotes in poor condition, and paper and even polymer notes wear out much faster than coins. 5. Cost of transport. Coins can be expensive to transport for high-value transactions, but banknotes can be issued in large denominations that are much lighter than the equivalent value in coins. 6. Cost of acceptance. Coins can be checked for authenticity by weighing and other forms of examination and testing. These costs can be significant, but good quality coin design and manufacturing can help reduce these costs. Banknotes also have an acceptance cost, the expense of checking the banknote's security features and confirming acceptability of the issuing bank. The different advantages and disadvantages of coins and banknotes imply that there may be an ongoing role for both forms of bearer money, each being used where its advantages outweigh its disadvantages. Thank you for watching this video.